Welcome back to the Deep Dive. Today, we're digging into Nebius Group. That's ticker NBIS. Imagine this. A company basically born from a massive challenge, now aiming to take on the tech giants in this exploding AI infrastructure market.
Right, they're calling themselves a neocloud pure play.
Exactly. And the question is, can they really thrive? The share price was around $64.91 on September 5th, 2025. Our analysis suggests the intrinsic value could be significantly higher, but there are some really serious risks they need to navigate to get there. You'll definitely hear about those. So our mission today is to really unpack the key insights from the sources you've shared to help you understand if Nebius Group NV truly has a sustainable edge in this whole AI infrastructure revolution.
It's a fascinating space right now.
It really is. We've split this deep dive into two main parts. Part one, we'll cover the core business, the management team, and the financials.
The fundamentals.
Right. Then in part two, we'll pivot. We'll look at market sentiment, the ownership structure, really break down the risks, and then pull it all together in our conclusions.
Sounds good. Let's dive in.
Okay, let's get started. Chapter 1, Business Analysis. So at its heart, Nebius runs on this AI as a service model. They give folks on-demand access to high-performance computing, but it's specifically tuned for AI.
And what really jumps out immediately is that they're vertically integrated, a full-stack platform. They control the tech from the hardware, the actual servers, all the way up to the software layer.
Okay, so that control.
Yeah.
How does that translate into actual revenue? What are their main streams?
Well, what's interesting here is how they've carved out these specific ways to make money from that deep integration. The biggest one is GPU compute as a service. They're essentially leasing out massive clusters of NVIDIA GPUs. We're talking the top-tier stuff, H100s, H200s, even the latest Blackwell series.
Well, the cutting edge.
Exactly. Hourly or long-term leases. And this hits the nail on the head for the biggest bottleneck in AI right now. Just getting your hands on enough processing power.
Right, the compute shortage.
But it's not just the raw compute. They also have managed services and platform fees. This is recurring revenue. Think things like managed Kubernetes, which helps orchestrate complex applications, or Slurm-based clusters for high-performance job scheduling.
So tools to make it easier to use all that power.
Precisely. Tools like MLflow for the machine learning lifecycle, PostgreSQL databases. It reduces the operational headache for their customers, makes it easier to actually do the AI work.
Makes sense. Provide the power, but also the tools to wield it effectively. And I saw something about an AI studio platform. How does that fit in?
Yes. The AI Studio platform is kind of their generative AI workbench. It gives API access to over 60, state-of-the-art open source models.
Yeah.
The big names like Llama, Mistral, Stable Diffusion.
So developers can just plug into these models.
Right, usually with per-token pricing for inference. But crucially, it also offers features for fine-tuning these models, making them better for specific tasks. And also retrieval augmented generation, RAG, which lets models pull in external data for better answers. It's aiming to be a complete ecosystem.
Interesting. Now, beyond the core cloud stuff, the sources mention these other assets. Avride, Triple 10, and stakes in Toloka and ClickHouse. They seem a bit scattered. What's the strategic play there?
Yeah, they do seem diverse at first glance. Avride in autonomous driving, Triple 10 in ed tech, Toloka in AI data labeling, ClickHouse in high-performance databases. But look, while they aren't the main revenue drivers today, they're really strategic assets, almost like a hidden war chest.
A war chest? How so?
Well, think about it. These aren't just random investments. They represent potentially billions in non-dilutive funding down the line. Nebius could, sell off stakes or spin these out when the time is right. That gives them huge financial flexibility without having to issue more stock and dilute existing shareholders. That's a big advantage many competitors don't have.
That's a really smart angle. A way to fund growth without hitting the equity markets constantly.
Okay, let's talk about their market position and scale. They bill themselves as a neocloud, focusing purely on AI infrastructure. How does that really set them apart from the big hyperscalers, Amazon, Microsoft, Google, and what kind of scale are we talking about here?
Right, so neocloud means they're purpose-built just for AI workloads. Unlike the hyperscalers who offer, everything under the sun in the cloud, this specialization is their core differentiator. Scale-wise. Their market cap is around $15.46 billion as of early September 2025, so definitely large cap territory.
Okay.
Physically, they've got data centers running in Europe, Finland, France, but they're really pushing hard on U.S. expansion. Major facilities are being built in Kansas City, Missouri, and a huge 300-megawatt campus in Vineland, New Jersey.
300 megawatts, that's enormous.
It is, and the goal is audacious, over 1 gigawatt of total power capacity by the end of 2026. It's a massive global build-out, a gigawatt by 2026.
Wow.
And financially, they did $117.5 million revenue in FY 2024, but management's guiding for an annualized run rate of $900 million to $1.1 billion by the end of this year, 2025. That's explosive.
Explosive is the right word. And that rapid acceleration is central to their primary value proposition. Nebius is basically offering this purpose-built, high-performance environment that's also cost-effective. It aims to be just better for AI development.
Better how? Faster, cheaper.
Both, ideally. But the real game changer they're aiming for isn't just raw speed, it's performance per dollar. Think of it like getting more AI processing power for every dollar you spend compared to the general purpose clouds. They want to slash the total cost of ownership, the TCO, for AI projects.
So making advanced AI more accessible, economically speaking.
Exactly. Democratizing access, accelerating innovation for startups, enterprises, research labs, everyone.
That's definitely a compelling pitch. Okay, let's shift to the broader industry analysis. Nebius sits right at that intersection of cloud computing and AI. Management calls it a once-in-a-generation opportunity. What trends are fueling this?
Yeah, the timing seems spot on. The overall public cloud market is huge, projected $723 billion in 2025, growing over 21%. And AI is the main driver. The tailwinds are massive. You've got the generative AI explosion, wider adoption of AI as a service models, and just this ballooning demand for specialized AI infrastructure.
Because the general clouds aren't always the best fit.
Right. Companies are realizing that while hyperscalers are powerful, their general purpose setups aren't always optimal or cost effective for these super intense specific AI jobs.
Makes sense. But Nebius isn't the only one noticing this. The competitive landscape looks brutal. You've got the giants, AWS, Azure, Google Cloud with near infinite resources, and then other focused neoclouds like CoreWeave, Lambda Labs, Voltage Park. How does Nebius actually stand out?
It comes back to that unique, vertically integrated, full-stack approach. Hyperscalers offer incredible breadth and scale, but maybe not the fine-tuning for AI cost or performance. Other neoclouds, like, say, CoreWeave, might be really strong on the raw compute side, but maybe offer less of an integrated software layer.
So Nebius tries to bridge that.
That seems to be the strategy. Combine the dedicated, optimized infrastructure with a really comprehensive, cohesive software platform built only for AI performance and ease of use together.
Okay. And the regulatory environment around AI that's evolving fast. What are the main hurdles there?
Oh, it's definitely complex. You've got data privacy rules like GDPR in Europe, CCPA in California, then new AI-specific stuff like the EU AI Act, plus industry rules like HyperDAF for healthcare.
And government compliance, too. I see FedRAMP mentioned.
Right. It's a minefield. But their EU data centers are actually a strategic plus here, helping customers meet GDPR requirements. It's a challenge for everyone, but Nebius seems proactive.
Speaking of challenges, what about barriers to entry? Surely you can't just spin up an AI cloud overnight.
Absolutely not. The barriers are huge. Colossal, really. First, massive capital. Nebius themselves are planning around $2 billion in CapEx just for 2025.
$2 billion.
Then you need incredibly deep tech expertise, very strong relationships with suppliers, especially NVIDIA, to get those GPUs everyone wants.
And the talent.
Exactly. Finding and keeping top AI engineering talent is fiercely competitive. Add the economies of scale the big guys already have, and yeah, it's incredibly tough for newcomers.
So given those hurdles, how does Nebius build its competitive advantage? Let's start with brand strength and recognition. They only rebranded from Yandex ND in August 2024. That's pretty recent.
It is. They're essentially building that brand reputation in the AI dev community right now, but they have some strong points. Being an NVIDIA reference platform cloud partner is a massive stamp of approval, huge credibility boost.
Okay.
And there seems to be growing positive word-of-mouth developers talking about it being easy to use, reliable, and genuinely cheaper for AI tasks. Plus, you can't ignore the founder's reputation. Arkady Veloz is a known quantity in tech.
Any weaknesses mentioned?
Yeah, some user reports mention customer support response times can be slow. That's a pretty typical growing pain for a company scaling this fast, but something they'll need to address.
Right. What about cost advantages or economies of scale? Is it just about buying GPUs in bulk?
It's not just bulk buying, though, that helps. Their edge seems to come more from architectural efficiency. Because they're vertically integrated and purpose-built only for AI, they can optimize everything: cooling, power, networking, the software stack specifically for those workloads.
Leading to lower operating costs.
That's the idea. Lower power consumption, better hardware use, less overhead. And that supposedly translates to better performance per dollar for customers. Reports suggest they can offer pricing up to 30% lower than hyperscalers, maybe even 35% discounts for longer commitments. That's significant.
Very significant. And that level of integration, does it create network effects or switching costs, make it hard for customers to leave?
Oh, absolutely. It seems designed for stickiness. First, there's data gravity. Moving massive AI data sets out of a cloud provider costs a lot in egress fees. That alone is a big barrier.
The cost of leaving.
Right. Then, customers integrate their MLOps pipelines, their whole machine learning workflow deeply with Nebius's specific tools and APIs. Untangling that is complex and expensive. Plus, teams build up expertise on the Nebius platform. Retraining or rebuilding workflows elsewhere is a major hassle and cost. High switching costs seem baked in.
Okay, so beyond the cost and stickiness, what are their truly unique assets or capabilities? What really makes them stand out?
I'd point to 3, maybe 4 things. First, that vertically integrated full-stack platform. That control is key to optimization. Second, the proprietary engineering and design expertise. This team comes from Yandex. They built world-class systems, even supercomputers like ISIG, which ranked 19th globally at one point. Deep engineering DNA. Third is that portfolio of strategic tech assets we talked about. Avreed, 1010, Toloka, ClickHouse. That war chest for non-dilutive funding, insights, maybe even cross-selling, it's unique.
And the fourth?
The fourth is maybe less tangible, but incredibly important. The Yandex divestment itself acting as a strategic catalyst. That whole crisis, the sanctions, it forced them to shed the Russian assets and the massive geopolitical risk associated with them.
A purification almost.
Exactly. It clarified their mission, allowed them to align fully with Western markets, and crucially, opened doors for partnerships like the one with NVIDIA and attracted top U.S. venture capital. That wouldn't have happened otherwise. It fundamentally reset their trajectory.
That's a really insightful take on how crisis became opportunity. Okay, let's move on. Chapter 2, Management Evaluation. Leadership is obviously make or break for a plan this ambitious. Let's talk about the CEO, Arkady Veloz, his track record and crisis response history.
Well, Veloz isn't new to this. He co-founded Yandex, built it into a $30 billion giant at its peak. That demonstrates serious innovation and scaling ability. And the period from 2022 to 2024 was just an incredible test of leadership, facing EU sanctions, an existential threat, really.
Right.
He resigned as CEO of Yandex NV. The team navigated that incredibly complex $5.2 billion sale of the Russian business, managed to keep the international assets, recapitalized, rebranded as Nebius, and got it relisted on NASDAQ in October 2024.
That's quite a turnaround.
It shows exceptional crisis management, real resilience under immense pressure.
And how about communication, transparency, and ethical reputation now as Nebius?
They seem to be hitting the right notes for a U.S.-listed company. Comprehensive investor relations site, newsroom, standard stuff, but done properly. They've also proactively set up formal governance, code of conduct, anti-bribery policy. And importantly, Veloz himself publicly condemned Russia's invasion back in August 2023. That was a clear signal, mitigating reputational risks and aligning the company publicly.
Okay, let's talk capital allocation. The strategy is described as blitzscaling, aggressive investment in the core business.
That's putting it mildly. They're planning roughly $2 billion in capital expenditures just for 2025.
$2 billion. And that's mostly for...
Almost entirely for building out those global data centers, aiming for that 1 gigawatt power target by the end of 2026. Funding-wise, they had a strong cash position, $1.68 billion end of Q2 2025. Plus, they recently raised another $1 billion through convertible notes and a private placement.
Any M&A activity? Acquisitions?
Nope, none mentioned. The growth seems purely organic right now, laser-focused on the build-out.
And share buybacks or dividend policy? I assume none, given this spending?
Correct. No dividend, no history of buybacks. Every spare dollar is going back into fueling that aggressive growth. Pretty standard for this kind of hypergrowth phase.
Okay, so given all this spending, the return on invested capital, ROIC, must look pretty bad right now.
It does. Normalized ROIC is negative, around 9.74%, but that's completely expected. You wouldn't invest in Nebius based on current ROIC.
You're betting on the future returns from these investments.
Exactly. The focus is entirely on the future trajectory as these massive data centers come online and start generating revenue and, eventually, cash flow. And again, those non-core assets are a key differentiator here. That potential for billions in non-dilutive financing provides a cushion and strategic flexibility that pure-play competitors just don't have. It's a unique part of their capital structure story.
Right, that war chest again. Okay, let's get into the numbers. Chapter 3, Financial Analysis. All right, market cap. We said around $15.46 billion as of early September 2025. Now, revenue growth trends. You stressed ignoring the old Yandex NV data. So what does the Nebius story look like?
Yeah, that distinction is critical. So Nebius Group reported $117.5 million for the full year 2024, but the key numbers are more recent. Q2 2025 revenue was $105.1 million. That's up a massive 625% year over year.
625%.
Yes, and up 106% just from the previous quarter. That sequential growth shows incredible acceleration. That's the number-grabbing headlines.
Wow. Those are genuinely eye-watering growth rates. But what about profit margins? All that growth must come at a cost.
It absolutely does. If you look at gross profit margin for Q2 2025, it was actually pretty healthy, 57.34%. That suggests the core service itself is profitable.
Okay, so the underlying business model works.
Right. But then you look at operating profit margin, it was negative 197.22%.
Whoa, deeply negative.
Deeply. But again, expected. That reflects the huge investments in R&D, sales, marketing, general admin, everything needed to scale at this speed.
And net profit margin. If I saw a positive number, 76%, but you said that's misleading.
Highly misleading. That TTM number includes a one-time, non-cash $500 million accounting gain from the restructuring. If you look at adjusted net loss for Q2 2025, which strips out those kinds of things, it was $91.5 million. Still a loss, reflecting the heavy investment phase.
Okay, that makes more sense. And following from that, free cash flow generation is obviously deep in the red.
Correct. Significant negative free cash flow. For the first half of 2025, operating activities burned $352 million, and investing activities, mostly the CapEx, burned another $1.05 billion.
Financed by their cash and the recent debt raise.
Exactly. They're funding the burn from their strong balance sheet, but it's definitely a key metric investors are watching closely.
So earnings consistency, not really applicable yet. They're expected to post losses.
Right. No history of consistent earnings for Nebius as a standalone entity. They're forecasting losses. However, management did say they expect the core AI infrastructure business to hit positive adjusted EBITDA in the second half of 2025.
Ah, okay. That'd be a big milestone.
A huge milestone, a major de-risking event if they achieve it, shows the core operation is heading towards self-sufficiency.
Now, on the stability side, the debt-to-equity ratio looks very low, 0.261. And the current ratio is exceptionally high at 14.70. That sounds incredibly strong.
It really is. A very conservative balance sheet, especially given the growth ambitions. Cash of $1.68 billion actually exceeded their total debt of $986 million at the end of Q2. Wow. That low debt and sky-high current ratio mean outstanding short-term financial health. No near-term liquidity worries. It's genuinely a fortress balance sheet.
Which is crucial for funding that multi-billion-dollar plan over several years.
Absolutely. It significantly de-risks the investment from a will they run out of money perspective. They have the runway.
Okay. And obviously, no dividend stability and growth to talk about. So let's turn to valuation analysis. Standard price to earnings, PE ratio is useless here because earnings are negative. Analysts typically use price to sales or EV to revenue for these types of stocks.
Correct. You have to look at revenue multiples or try to model future cash flows.
So we used a discounted cash flow or DCF model for educational purposes to try and estimate intrinsic value. What range did that spit out?
Based on the inputs, our educational DCF model suggested an intrinsic value range of roughly $75 to $95 per share.
Okay, $75 to $95, that's quite a spread. What were the key assumptions driving that? Because DCS is very assumption dependent.
Hugely dependent. Key inputs were hitting that $1 billion revenue run rate by end of 2025, then assuming really high growth, 80% annual for the next 2 years, slowing to 40% for years 3, 5, then tapering down to a long-term 3% growth rate.
Very aggressive growth assumptions baked in there.
Necessarily so, given the market context and guidance. We also assumed a long-term free cash flow margin of 25%, similar to mature, scaled cloud players.
And the discount rate?
We used a relatively high discount rate, a WACC of 12%. That's higher than you might use for a stable company. Deliberately chosen to reflect the elevated risks here, the execution risk, the intense competition, the inherent volatility.
Got it. So pulling that financial picture together, explosive growth, heavy losses currently, but a path to positive EBITDA potentially soon. And critically, an exceptionally strong balance sheet with tons of cash and low debt to fund the journey. That financial strength is a major de-risking factor for the whole multi-billion-dollar investment plan.
That's a fair summary. The financial foundation looks remarkably solid for such an ambitious undertaking.
All right, let's take a short break, and then we'll dive into part 2. Market sentiment, ownership, risk, and our final conclusion. Welcome back to the Deep Dive. We're unpacking Nebius Group, NBIS. We've covered the business, management, and financials. Now let's get into part 2, starting with chapter 4, market sentiment. What's the general feeling on Wall Street about Nebius right now? Analyst ratings, price targets.
The sentiment seems overwhelmingly positive, actually. The consensus rating from analysts covering the stock is a strong buy.
Okay, strong buy. What about price targets?
The average one-year targets are hovering in a range from about $79.75 up to maybe $91.19. Some more optimistic calls go as high as $134.40 per share.
Wow, so compared to the current price around $65, that implies potential upside from, what, 23% up to over 100%?
Exactly. Suggests Wall Street really buys into the growth story and sees significant room to run.
And what about the general media tone, especially after those big Q2 earnings numbers?
Yeah, the media coverage has been very positive. Lots of headlines focusing on that staggering 625% year-over-year growth in Q2, following strong growth in Q1, too. They're often portrayed as a rising star in AI infrastructure.
Sounds like a consensus view. But is there a counter-narrative? What does the short interest look like?
This is where it gets really interesting. There is a significant opposing viewpoint. As of mid-August 2025, there were almost 15.8 million shares sold short.
15.8 million. What percentage of the float is that?
That works out to 8.05% of the float, which is pretty significant.
Okay, so definitely not insignificant. What does that tell you?
It tells you Nebius is very much a battleground stock. There's a strong bullish camp, obviously, but also a determined bearish contingent betting against it. High conviction on both sides.
Interesting dynamic. And technically speaking, how's the stock price looking relative to its moving averages?
Technically, it looks strong. It's trading well above its 50-day moving average, confirming positive short to medium-term momentum.
And the longer term, the 200-day.
Also trading significantly above its 200-day moving average. So technically, it's in a confirmed long-term uptrend.
Okay, so you have this setup. Strong bullish analyst sentiment, positive media buzz, confirmed technical uptrend, but also a significant chunk of investors betting against it via short interest.
Exactly. It creates this high volatility environment. You've got explosive growth potential meeting real skepticism. It sets the stage for potentially short moves, short squeezes on good news, or quick sell-offs if there's any sign of weakness or missed expectations. Definitely not a stock for the faint of heart.
Good point. Okay, let's move on to Chapter 5. Ownership structure. Who actually owns Nebius? What do the top institutional ownership patterns show?
It's got a pretty strong institutional following already. Around 488 institutions hold shares, collectively owning about 82.3 million of them.
Any big names in there?
Yeah, some well-respected firms. Orbis Allen Gray, Fred Alger Management, Excel Leaders, Slate Path Capital, Invesco. Solid names. Looking at recent activity, it seems fairly balanced. Some buying, some selling, suggesting maybe a period of consolidation among institutions after the relisting and initial run-up.
What about insider holdings? Does management have significant skin in the game?
Oh, yes. Exceptionally strong alignment here. The founder and CEO, Arkady Veloz, directly owns 12.9% of the company.
12.9%. What's that worth, roughly?
At current prices, around $2.0 billion. So yes, extremely significant alignment with shareholder interests. His success is directly tied to the stock's success.
Any recent insider buys or sells in the open market?
No, none reported in the last 12 months. That's not too surprising given the recent restructuring, relisting, and capital raises. Insiders are likely subject to lockup periods or just holding tight.
So the ownership concentration is pretty high then, between the founder and top institutions.
Reasonably concentrated, yes, and that can be a positive. It provides stability, allows management to focus on executing that long-term, very capital-intensive strategy without constantly worrying about short-term market pressures. Critical for a build-out like this.
Makes sense. Stability for the long haul. Okay, now for a crucial chapter. Chapter 6, risk assessment. Let's use a SWOT analysis framework. Start with the strengths. What are Nebius's core internal competencies?
Okay, strengths. Number 1. That proprietary full-stack technology, vertically integrated for performance and cost efficiency in AI. 2, strong founder-led management. Veloz has a proven track record, huge ownership stake, and navigated that intense crisis.
Right.
3, the fortress balance sheet. That $1.68 billion cash, low debt, high current ratio gives them massive funding runway. And 4, that key strategic partnership with NVIDIA, being a reference platform partner, gives them early tech access and major credibility.
Okay, solid strengths. Now the flip side, weaknesses. What are the internal limitations?
Weaknesses. Well, first, the obvious. Current unprofitability and high cash burn. Makes them vulnerable if capital markets tighten or there are unexpected delays. Second, limited global brand recognition. They're still the new kid on the block, building trust after the rebrand. Third, significant execution risk. This global data center build-out is a monumental undertaking. Flawless execution is required, and that's a huge challenge. And fourth, potentially customer support scalability. As they grow super fast, can support keep up? We saw hints of that potentially being a friction point.
Right, growing pains. Okay, what about external factors? The opportunities ahead.
Opportunities are huge. First, the massive and growing total addressable market. They're a pure play on exponential AI infrastructure demand. Second, gaining market share from hyperscalers, specifically targeting customers unhappy with general-purpose clouds for specialized AI tasks.
The performance per dollar angle.
That's exactly. Third, monetization of non-core assets. That potential for billions in non-dilutive funding from their strategic portfolio is a unique opportunity. And fourth, straightforward geographic expansion. Building out across the U.S., Europe, potentially the Middle East, opens up vast new customer bases.
Okay, lots of potential upside. Now for the threats. What are the general external challenges?
Threats are also significant. Top of the list. Intense competition from the hyperscalers with deep pockets and broad reach, and from other agile-focused neocloud providers. Second, technological obsolescence. AI hardware and software evolve at lightning speed. A major shift could disrupt their current model or advantage.
That's always a risk in tech.
Always. Third, the evolving and complex regulatory landscape. Increased compliance costs, potential restrictions on data flows. It's a constant challenge. Fourth, potentially customer concentration risk, especially in these early stages. Relying too heavily on a few large customers can be risky if one leaves. And here's a crucial point. Their deep specialization in AI is their greatest strength, but maybe also their greatest systemic risk.
How so?
They are a pure-play bet on the AI compute market. Unlike hyperscalers, who are diversified across many cloud services, Nebius lives or dies by AI infrastructure demand and their specific approach to it. The challenge isn't just to be better than hyperscalers at AI, but so much better that it convinces large enterprises to adopt a new, specialized provider, maybe even manage multiple clouds, instead of just sticking with the easy, bundled option from their existing hyperscaler relationship. That's a high bar.
That's a really critical strategic point. It's all in on AI compute.
Yeah.
What about broader macroeconomic factors? Interest rates, inflation.
Definitely threats. Higher interest rates increase their cost of borrowing for that huge capex, and they also increase the discount rate used in valuations, putting pressure on growth stocks like Nebius. Inflation directly impacts costs. Building data centers, buying energy, hiring talent all get more expensive, potentially squeezing future margins. These are real headwinds.
And any specific geopolitical factors to watch?
The big one is global supply chain disruptions, especially concerning their critical dependence on NVIDIA GPUs.
Which are mostly made in Taiwan.
Exactly. Any geopolitical instability, new tariffs, trade tensions that could lead to GPU price hikes or, even worse, severe delivery delays that would directly hit their growth targets and ability to build out capacity. It's a major external dependency.
Okay, a comprehensive look at the risks and opportunities. Let's wrap things up. Chapter 7. Conclusion. We've covered a huge amount of ground on Nebius Group. Let's try to synthesize this. First, can you summarize the key bullish points? What's the core bull case?
Okay, the bull case in a nutshell. 1, hyper-growth in a massive expanding AI market, proven by that staggering 625% recent YoY revenue growth. 2, a differentiated, vertically integrated tech stack, promising superior performance and cost efficiency for AI. 3, strong, aligned, founder-led management with a huge personal stake and a demonstrated ability to navigate extreme crises. 4, a fortress balance sheet providing the financial runway needed for their ambitious global expansion. And 5, that hidden value and strategic flexibility from their portfolio of non-core assets, offering potentially billions in non-dilutive funding options.
Okay, sounds compelling. Now the other side, what are the key bearish points? The core bear case.
The bear case. 1, tremendous execution risk. Successfully building out this complex, expensive global network flawlessly is a huge if. 2, intense and asymmetric competition. Battling tech giants like AWS and Google, plus nimble startups, is incredibly difficult.
Right.
3, Current unprofitability and high cash burn makes them vulnerable to market shifts or funding drying up despite the strong balance sheet currently. 4. A potentially stretched valuation that might already assume years of perfect growth and execution are a given. The market may have priced in a lot of optimism. And 5. That high short interest, signaling significant skepticism and a belief among some investors that the challenges outweigh the opportunities or the price is just too high.
Execution, competition, cash burn, valuation, skepticism.
Got it.
So let's revisit the valuation. Our educational DCF model gave a range. Remind us what that was.
Our model, based on those aggressive but plausible assumptions, suggested a theoretical intrinsic value range of $75 to $95 per share.
Okay, and the stock is currently trading around $64.91 as of September 2025.
Yeah.
So it's below the low end of that educational range.
Correct.
Yeah.
Which, on the surface, suggests potential long-term upside if, and it's a big if, management successfully executes this incredibly ambitious strategy.
But that wide valuation range itself tells a story, doesn't it?
It absolutely does. It underscores the substantial execution risks we discussed, the intense competitive uncertainties, and just the high degree of volatility you have to expect with this kind of investment. Nebius is clearly a high-risk, high-reward proposition. Its future is completely tied to its ability to navigate all these challenges and carve out a meaningful piece of this potentially generational opportunity in AI infrastructure.
So the final provocative thought for you, our listener. As AI keeps reshaping everything, will these specialized neoclouds like Nebius become the essential high-performance backbone? Or will the sheer scale and gravitational pull of the established tech giants ultimately prove too strong for focused players?
It's the key question, isn't it? A fascinating battle to watch unfold.
It really is. If you found this deep dive valuable, please do remember to like and subscribe to Stock Analytics AI right here on YouTube. Just a reminder, members paying €4.99 a month get priority deep dives on specific tickers you request. We're planning to cover all of the S&P 500 stocks over the next few months, and members get exclusive priority access to those insights as they come out.
And if you just want a one-off deep dive on a particular company that's important to you, dropping us a super thanks is a great way to support the channel and get your request prioritized.
Absolutely. And the important disclaimer, please remember, this deep dive was generated by an AI system. It's for educational purposes only and should absolutely not be taken as financial advice.
Always do your own thorough research, consider your own circumstances, or consult with a qualified financial advisor before making any investment decisions.
Thank you so much for joining us for this deep dive.